So what is liquidity in the Forex market? Liquidity is basically where we're going to find those buy orders and sell orders in the market above those swing highs and swing lows. Now liquidity is engineered all over the place, but it's understanding why this engineered liquidity is created to manipulate you into thinking to buy or sell that market. Let's have a look at this pound US dollar chart, and I'm going to show you right now what liquidity is. Okay, understanding this last bearish move and how it's formed to create this bearish move here in the market. So liquidity is, just as I said, those orders are created, buy orders and sell orders are created above swing highs, swing lows. So where we're going to find those stop losses placed. Now what's a stop loss going to create on a sell order? It's going to create a buy stop. Okay, so we have buy orders sitting above. We're also going to have those breakout traders. Again, it's going to place those buy stop orders. So let me just show you, we have this move here to downside. What that do? We're going to break a structure. Now what that creates here, let me just get an arrow. This move here up, okay. Let me just grab that arrow again. This move here to the upside is our last, okay, buy to sell move here in the market. So that creates our area of supply. And it's this area of supply where we're going to find those banks, institutions are interested in looking to sell from. Let's make sure that's the right place. Now we can use the full zone. Place it there. So this is our full zone. Now we don't have to use the full zone. We can refine it to the last area, but I like to look at the full zone. Now, if you want to learn more on supply and demand and how we use supply and demand, there is a full playlist in this channel. I do suggest, after watching this series, okay, through this playlist of understanding liquidity, then go through and learn about the supply and demand techniques. But how we look at liquidity, okay, in the Forex markets is very simple. When we see this breakout, you see this small pullback before continuation, that creates a swing high. Now, above this swing high is where you're going to find those orders on the stop loss, okay, are going to be sat above that high on the sellers to the downside. Now, when these orders are taken, that's going to create the buy stop, okay, the buy orders. And then this liquidity area will be run, okay, with those buys being run. Now, when this happens, you're also going to have breakout traders there as well, who are going to be looking for the breakout retest or just the breakout of this area. Because on the way down here, we also have these highs created, which actually creates an area of liquidity to the downside. Okay, as the market continues to run down, this liquidity at some point will be run. So the market is then pushed through. Let me just do that again. The market here is pushed through another breaker structure. So you can see we have this break to downside, this pullback, internal area of liquidity created before we break out again. Hey traders, we'll get back to the video in just a moment, but I wanted to give you a gift for hanging out with me today. I want to give you access to my Telegram community. This trading community will share my chart markups and give you access to my trading strategy. But it's more than just a community. You're going to have some actionable steps to accelerate your growth with hanging out with other like-minded traders, all looking to improve their trading. And it's free as my gift to you. So just hit the link above now to join the Telegram community. Now back to the video. So when the market comes down to this low here, and again looking to the left, we're sweeping these lows here, which is more liquidity. The market's going to run back up where what you believe is going to be sat above these highs. All these highs here will be used for those stop losses, okay? And when we're going to see potential breakout traders looking to break this trend line, they will place their buy stop orders. These stop losses will be basically buy stop orders. So they're running that buy area, okay, where the markets will be run, they're looking to buy that market. Now the banks, institutions, they know this is what's going to happen. They're manipulating you into believing this, especially when you see this strong big bullish candle here to the upside. Now what does this leave over? This leaves over a liquidity gap, an area of imbalance. And again, if you want to learn more on imbalances, there's a full playlist. I'll leave a link above now to go through and learn about the imbalances. But these areas of imbalances, they will create, like I said, an area of liquidity in the market. So we don't just have liquidity at these swing points. We also have liquidity within these imbalances. So what they're doing here is they are manipulating you into selling the market. Off this swing high, we run all this area of liquidity, we sweep that last high. This is a run on liquidity, and this is a sweep of liquidity. That's how we identify liquidity in the market, and later on there is a video that goes through more depth on how we identify this and how we look at these sweeps and runs. It's just to tell you really what liquidity is in the Forex market. The idea of liquidity is to bring in these buyers, and then once we see this sweep is to bring in the sellers. But this area of liquidity and this imbalance holds price. We never close it. And again, it runs the market higher to run this swing high of liquidity again. So why do they run this final swing high? Because it's the liquidity sitting below this area of supply. It's this area of supply where they wanted to take a sell from. This liquidity all gets run into the supply, and then we see the big drop to downside to run this low. And that's where this big bearish move comes from this engineered liquidity. And later there will be a video going through more depth on engineered liquidity. But this is just to tell you what liquidity is and how to understand why it works in trading. Now we're going to look at how to spot liquidity in the Forex market. Remember in the last video we spoke about liquidity is going to come from those swing points in the markets, and also we're looking at those liquidity gaps, which is actually those imbalance levels. So how can we spot liquidity easily in the markets? Well, the easiest way, and I'll show you quickly with a brief sketch here, is we're looking for patterns. Now those patterns can be where we see a double top can be created. And this double top here is the most common one you're going to see, which will create an area of liquidity. So let's just create a sweep there. So we can see here that the market is creating a double high. Now, very often you've probably been taught to sell off a double high or buy off a double low. That is not how I trade. That is not the way I look at the markets. What I'm looking at here is when we see this liquidity created, and this is how you can easily spot this. And it can be like a double test like this. And we can also see a double test to the downside like this. That's going to create, once again, that area of liquidity. Like I said, these are the most common. What we're looking for is for an area of supply or an area of demand, okay, to be sitting above or below those liquidity points. And very, very often, this is where you're going to find that the markets will manipulate you into selling from these highs, expecting a break of this low to continue, and then you see a pullback to run the liquidity here into the supply, and then a continuation. Now the same we said, you can see the pullback to run liquidity of the lows here into demand, then the continuation. This basically is how to spot that liquidity. This is the true movement in the market. This is spotting that liquidity. So that is the most common one you're going to find. And you're going to find these are set up above or below areas of supply and demand. Now, the other way we can look at the liquidity as well, and let me just get my tool back, is we can look at the liquidity to be sweeps in the market as well as liquidity runs. Now, there'll be a future video which goes through all that. Instead of going through in today's video, it's just really how to spot them on a chart. So let's look at this price chart. We also have one other way we can look at liquidity. Let me just quickly do a sketch for that. We can have a trend liquidity, which is your common trend line, okay? Your trend line can become an area of liquidity, which may want to be run. Now, the trend line would be the low here. Okay, on an uptrend, your low would be that area of liquidity. Now, majority of times, you most probably already been taught, okay, let me just mark this out as a sweep area. We are taught, okay, as retail traders, that you're looking to take a buy off a trend line, okay, which can work. Looking for a retest of a trend line continuation. Now that can work if the right conditions are there. But most of the time, what you're going to find here is, let me just put that back, is you're going to find down here, okay, is your area of previous demand. Let's say we had the market push into, but down below, we're going to have a large area of demand, potentially where price has not yet come into. And what you're going to find is that this area is going to act as liquidity for the market to push through, and then we see the true move away. I've seen this happen above an area of demand. We see a push out, and the market basically just wants to run deeper into that demand. And this comes into understanding a fresh and tested zone as well. And again, this is all inside that supply and demand playlist. So there is how we look at liquidity. Let's see how we can spot it now on this price chart. And we can identify, let's look at this move here to the upside where we can see a break of structure. Okay, so this is a true break of structure to the upside. What do we have here on the way up? We have all this area of liquidity. Okay, so we have this run here to the upside, which is creating liquidity. The market is then breaking through this liquidity. We have an area here of demand. Okay, not quite into. You can see we push in with this candle, and then the market, we break structure here to the upside. We then break this small structure here on this area of demand as well. Okay, where we do push into that demand after we run all of this liquidity. Now what that means, this is a tested zone of demand down here. We run through that level, which is expected when we're looking at fresh and tested zones, and then we continue to push away. So all we're seeing here right now is this liquidity being run, okay? And that's how you spot that liquidity. You see all the lower wicks here being created above or out of this area of demand. And then we're looking for that run of liquidity again to run the swing high. So we continue along, and I just want to show you another example here. Let me just find one. Okay, so we have this area of demand. Fine tune that to the demand zone. And we have that double, well, we have this low here and here created, which is the liquidity created, okay, above the demand. So we have a break of structure to the upside. That's how we quickly and easily spot this. This is our break of structure. What's more important, we also see a sweep of the low here, which creates the area of demand. When you see these types of sweeps and then a runaway to break structure, they very often will create a great area of demand to look to trade from. Now, what we can identify here, we have the breakout, a pullback, a sweep of this high, but then we continue to move sideways, creating this liquidity here, even this swing low, and eventually we push through with a strong push down, which continues to do what? To run this high, which is a break of structure again. But that is the liquidity, okay, created here. Let's change that to a sweep area where we run these lows, okay, into this area of demand. And then the market pushes away. So you saw how we can quickly see the engineered liquidity. We have the line chart here of liquidity, which was pushed through into demand. And we have the double test low of liquidity, which is pushed through into demand. That's how we look at spotting that liquidity on the charts. You're looking for the good setups, okay? Now, again, if we look down here, I didn't mark it, but we have a sweep, okay, of the low when we rally away. This is a rally base, rally type of style of demand. You can see the sweep of liquidity, okay, before we push away. We create the liquidity inside, okay, double low there, and the trend line of liquidity as we push up, pull back through, we remove all that liquidity deeper into the demand for the push away. Now on this one, we actually moved sideways. We moved higher. This one we actually failed to move higher. We moved sideways, created liquidity, and dropped in and then pushed away. So you can see how easily it is for you to quickly spot that liquidity. You just need to understand those patterns we went through, okay, which was that double test. Okay, looking at this high as an area of liquidity. In the example down below, Let's draw this out. We can identify the liquidity was created. There is our double test. Okay, here we push through liquidity into demand and we push to break structure. The other one we was looking at was obviously the trend line of liquidity, which can be created. Okay, and we can see the market want to push down and then push away in that area of liquidity. There's that liquidity we pushed through into demand below, pushed away. Again, let's see if we can draw this out so you can easily spot this. There's our breakout. Now we do create a double low there, but then we start to create this liquidity on this trend line. And you can see the market then pushes down through. To start with, we pull back and then we start to push through that liquidity and then eventually through the low into demand. That's where we see the push away. That is how you can easily spot liquidity on the chart, is we're looking for those types of patterns of the double low or the trend line pattern to occur above or below the area of supply or demand. How to identify liquidity? That is the question I'm getting asked time and time again. So I'm going to briefly go through right now the best way for you to identify liquidity and how to look for those areas when you are trading for potential targets or when you're looking for potential entries. But let's go closer into this daily chart. Where do we see potential areas, okay, of liquidity? Now, the liquidity is going to be always above swing highs and below swing lows. So if we're looking at this current chart here, we would have liquidity sitting above this swing high. We would have liquidity sitting above this swing high, above this swing high. Okay, we would have it above this swing high. This is where the current liquidity would be left. Okay, so where we see it now sitting. Where was potential liquidity before and where did we see it run? We had some at this high. We got run through this candle. We had some at this high, which got run on this candle. So when we see a push through these liquidity swing highs and rejection candles, or even those engulfing candles, they are very, very good insights of a good potential entry. But let's say you are selling from up here. Where would you be looking to target? Well, you'd be having a potential target here and another one at this low. And if we look to the left, okay, another one this low. They would be the areas where you'd have potential stops and orders in the market. And that's all liquidity really is. We're looking to run the liquidity, okay, for your profit targets and to sweep those areas for your entries. If you can remember and take away this one simple method of understanding liquidity in the market, that is all you need to understand. Liquidity will always be at the swing highs and swing lows in the market. Now, we're not always going to see the liquidity run straight away. We're going to have a build up of liquidity as well, where we see equal highs and lows. Now, potentially you've been taught double highs, double bottoms are great areas to look for a trade, but what they're actually creating is more liquidity. Equal highs and lows are just creating more liquidity to be run. Let's look at this area right here. Does that create a sweep? That is potentially an area of liquidity. So roughly equal highs. That means at some point these highs will want to be run to take up that liquidity. So just have to bear this in mind. It's not always going to happen straight away. Look, if we look at this market to the downside, when we see a reversal, there's liquidity which got run. We closed through this level. That means that liquidity has now been taken. We have a pullback, okay, into an area here of demand. Now we had an area of liquidity below this low, didn't get run. But look what did happen on the way up. We got this low run and this low here was run. Those two areas were taken for an entry, okay? Liquidity was run to take any stops. The stops were taken to push the market higher. Where did it then go for? It went to run the liquidity at the swing highs. Okay, so that's where the market's going for. It's where profit targets are going to be sitting. That's where breakout traders are going to have that order sitting. Okay, so we have stop losses, we have orders, take profit levels. That is what's the makeup and the build up, okay, of understanding liquidity. So again, when market comes back, where are we going to run? We're going to run this high. There we have, we're a run of that high. Next, we're going to have a run of this high. We close through. Then we have this high. Look, we sweep that high only. So the market very often will sweep a high, pull back, then fill the market to run higher. Then we've got this high. This time we had to run through that high. And I don't think we actually made it to this high. We just below that high. Okay, so we didn't quite run to that swing high. But we can see on the way down that the market actually swept this high to get the orders to push the market lower. Why? So the market can run this low, which we pushed through. And if you look at this, what happened before that? We had to sweep this low to get the orders to push higher. Okay, we even swept here as well. And then the market could then push for these highs. Get a smaller high here as well, another high. Then we had these highs here to the left that got run. So if you just start mapping out your charts, looking at those levels in the market, where liquidity is going to sit, it's going to give you a much better idea, location of where entries can come from and where those profit targets can be. So let's just take everything off this chart. Let's just look now at this current area of price. If we're trading this, now you need a good understanding, of course, of the market structure. Now, if you're not sure on market structure, there's a full playlist in this channel. Go through each video, it will teach you how to apply market structure. If we're looking at market structure here, let's say we had a break here to the upside. We then had a break to the downside. Okay, we have a pullback. Where's the market going to run? It's going to run this to break structure to the downside. Now we're looking at another pullback. Where's it going to run eventually? It's going to run this low. Okay, so the market pulls back into areas of supply and demand. Again, there's a full playlist within this channel, how to understand, draw, and use supply and demand in your trading. There is also another playlist that goes through the use of imbalances. Well, I'm now going to talk about imbalances. Within this area here, we have an area of imbalance. We also have right here another area of imbalance. So we've just closed through that imbalance, which suggests that the market needs to push higher for more orders. Now there's orders left over in these imbalances. Now this is not the same as liquidity. If we used to see the market pushing up now to this area, where we're going to push to, we're going to push for these lows. Okay, so understanding this is where we can start to look for your profit targets. Now, if we were to drop down a time frame here on a 4 hour, you'll see how we can use liquidity for our areas to take a trade. If we're to look for a buy from here, where's a great location? Well, we have an area of imbalance that can push the market higher, but we can also see we have a swing low here. So that tells me that if the market can push down here, we can sweep this low. Very often we'll see another sweep and then a continuation to run this high, which will then become a new area of liquidity. That's what we class as a weak swing high, because at the moment we are bullish on this 4 hour time frame. So a sweep of this low, you can see a continuation to run this high, okay, of liquidity. So that's how we look at liquidity. Now, if you want to learn more on the use of supply and demand, I do suggest checking out the Profit Per Trade workshop. It's going to go through exactly how you can apply and master supply and demand. Go and check it out. There's a link below in the description of this video, and there'll be one popping up right now. Understanding liquidity, you can apply it with the use of your entries. Now, there are ways we can look at using this on a lower time frame. If we see the sweep on a higher time frame, that all comes into understanding confirmation of those areas. And again, you can learn that inside the Profit Per Trade workshop. Now, once we can start applying where we can look for our entries, you know where your target's going to be. You can look for the swing points. It's all you have to do. If we was to drop down to a 15-minute time frame, let's look at a 15-minute from here. What do we see? Right, okay, so where did the market here pushed up, we broke this structure high, I'd say. Then we've pulled back. We've created these areas here on the way up. We've dropped down, lower high, lower high. You can see we continue to push higher, and then we've pushed through. The market creates a sweep here. Okay, we've pulled back to do what? Well, we create kind of a sweep here of the low of this previous candle. It's not an actual sweep, but it's a sweep of that candle. We've then pushed higher, okay, to push through this swing high, which we failed to do. We swept through it. That's indication of a reversal in the market. Remember, when we say a sweep, we're not going to close through. It's not a break of structure. It's a sweep. So then that is a sweep of liquidity for potential reversal. Where does that tell me the market was going to go from here? It was going to go for this level. That is the nearest area of liquidity it needs to run. Okay, all these lows made in between, they're nothing. Okay, forget about them. We're interested in the previous low needs to be swept. Okay, there may have been one just there as well. I'm not quite close enough to see. There may have been one just there as well. So it may want to run this low first. Okay, so after this sweep, we went down, we closed through that low. We had imbalance to go through as well, and then we run through this low. Now, after that low is taken, we then have a swing low here. At the same time, that was pushed through. Then you have a swing low here. We push through that low. And again, we have a swing low here. Now, after that low has been taken, we then have the next one is lower down here. So we have quite a bit of space for the market to run to. And we can also indicate as the market breaks structure, we pull back, we'd expect it to run this low now, because that's our weak, okay, 15-minute weak low. But it's also where we can see potential stops and orders being placed. And it could even be targets as well, take profit levels. So just start to map out those charts. Forget everything else and just start using your levels. Read the markets, understand what is happening. A close through level is a break of structure, indication of a continuation. A closed through, okay, indication of a continuation. So if we was to close through this level now and we don't wick through and just a sweep, it's an indication of a continuation of the move. And that's all the trends are in the market. Okay, we're looking for liquidity to be run or liquidity to be swept. Liquidity in the market. How do you find it? How do you trade it? How do you use a line chart to find liquidity? So let's look at the different types of liquidity we're going to be looking at today and how we can use that with the line chart. There are two different types of liquidity we look for. We're looking for liquidity at swing highs, and we're going to look at what we call engineered liquidity. So let's have a look at what we'd be looking for. If we had a down move here in the market, okay, so this is our current move down. We then find the market makes a reversal and the market goes back up like this. This is a typical reversal area. Okay, when we see the market making this last push down to take our end liquidity down here and we're pushing up, okay, we can expect the market to want to run liquidity above these highs. These highs on these moves down will all have liquidity. Now I created this high, so it's equal high. That means when we see the market come up to this high and it fails to take that liquidity, it's pushing back inside here. Okay. And what we look at is our trading range. Okay. So our trading range would have been from, say, this high to this low. And we see the market going through that trading range. Now, as a way to understand whether a trading range is going to actually show you a reversal back down, okay, so with a trend or it's a full reversal. Now here we can understand that these swing highs are going to leave you that area of liquidity where price will want to run. Now when we have this pullback here, which I created this swing high to be an equal high, inside this area, you're going to find the market, okay, it's going to create those bullish swing moves like this. So what do you think this is going to create? When the market pulls back, on this swing pullback, it's running liquidity, okay, through these lows. Pull back, we run the liquidity again through this low, pull back, And finally, we're going to run liquidity at this low here to then pull back. Now, very often you're going to find the market's going to want to break through this high to run this here of liquidity, to engineer liquidity, so we can then run back down once again to take this low before we see the true reversal back to the upside. So let me just zoom in on this area. So when we're looking at this swing pullback, remember we just went through, okay? We know that these highs, these lows, and that's the perfect example, I know, but we can see that the market's running these lows all the way down, taking liquidity at these lows. We get to this final low here. So we run the liquidity within the trading range itself. At this point, this is our trading range. Now this is going with a breaker structure here to the upside, so it's going with a bullish trend. On the pullback, we're running through that liquidity. Finally, we run the low here, and you think the market's broken this high, and it's a reversal. So our internal structure has reversed. The market then pulls back after it's broken that structure once again to run this low, which is our engineered area of liquidity, to run higher, and then we pull back for the continuation. So I'm going to just do that sketch for you once more. So imagine this is our, okay, move down, pull back, move down, pull back on that trend. That's our internal swing down, okay? And eventually we see the breakout here to the upside. And at this point, you're looking for an area of demand to hold price to continue higher. Now that's what the normal area would be looking for, a buyout here, okay, to continue higher. Now, very normally, why we see this area, we see the break of this high. Now, very often it's going to be just more of a false break, okay, but still a valid breakthrough to bring in those buys to think it's going to higher. Now, what we're going to see very often here, let me just show you, is that very often when we have the market pushing up here, we're having this swing pullback to go higher with our swing structure. What we're actually seeing is that the market, and if I draw this in correctly for you, this is our, okay, move up, okay, and pull back, and then with continuation, leaving a new area of demand here, okay, for an entry. And what you're very often going to see is that the market is failing, okay, to go into this area of demand. We just sit above that demand zone and we break out. And what you need to say to yourself here, okay, you're pulling back into an area of demand to go with a trend, and we failed to get to that demand zone. Yes, we can see this show you a reversal on internal structure. So you've gone from a bullish swing structure to a bullish internal structure. That's how you'll read structure of the market, but there'll be another video going through structure in much more detail. But if you understand that this has failed to get to your demand zone, and we see this reversal, potentially what this is going to create is a sweep of the market, manipulation, false breakout, whatever you want to call it, okay, to bring in buyers back into this area of demand here. But what you're actually going to see in reality is that this move here will not happen, and will go down into that demand zone, taking the low once again, where we have the liquidity sitting engineered by that false break to the upside. And then you're going to see the true move back up with that swing structure. So hopefully you are understanding how this works. So this would be your true move to the upside. With that final push down and then a continuation up. So we just move that over. You'll see exactly what I mean. So if the move came down, takes this low, and then we push away. So this area of demand, you'll think, okay, didn't work. And it's just an early entry. But then you can see the market will pull back into a new area of demand created, which is a valid zone to buy from. And this is going to stop you taking trades too soon, getting losses you shouldn't be getting into. Let's go through this now on a line chart and see how this will look like on the line chart, how you can use this going forward. Now, there's also a way to look for liquidity at where we're going to find market close prices. So if we look at this area here, what we have is our simple line chart. And when we're looking for liquidity, we're looking for those areas where price will want to just wick through, okay, take that liquidity and run. Now, the liquidity we're looking at is we have an area here of liquidity where the market's going to go back, take those lows, equal lows here, runs them and continues higher. But the actual liquidity that you want to be trading, okay, let me see if we can find one, is right here. Okay, the current price, we have an area here of liquidity. We have price here. Let me just show you what happened. We have this continuation here to downside. So the market has been pushing down, okay, all the way down here. We've been pushing lower and then we pull back. The market pushes down. Internally, we break out here, one final push up, and then we continue to drop. That is taking liquidity, okay, within this trading range. So we have a swing high based on closed prices, this is, and a low. Within this move up, okay, we look for a liquidity move. So again, if we was to do this off this swing high and this swing low, there's no liquidity here. We create the liquidity here when we break through this low. This is what we class as that engineered area of liquidity, where the market's a false break to downside. We pull back for one final false break here to the upside. You can see how we come back into this area and then we continue the true move to downside. So let's look at now understanding this swing pullback. We're inside this trading range. Let's now go down to the 15-minute chart. Let's have a look at what happened here. And you'll start to really understand the markets. And I'm just going through a simple pair, the US dollar CAD, okay? And we can see the market does the pullback within this trading range. What do we have? We have not only that sweep, we also sweep this area here at the same time. So the market does what here? We come up, we pull back, okay? We do break the low here to downside, okay? Equal lows here. So what we create here, in fact, is the area of liquidity. Mark that out for you. Area of liquidity that want to be taken. There is the last first push up. Okay, we pull down, remove this high. So we take out this high with this move up. We then break down once again and one final push up again to remove the first and the second area. And then we have the true breakdown to take out that low here of liquidity. Now, this is quite confusing if you're not really sure about understanding the way the markets move with liquidity, and using a line chart is going to make this much more simple. Let's go back to the 4-hour. Let me demonstrate this again, okay? I haven't even looked at this chart, and this is what I'm now doing. I'm going through it for you. So we have again, okay, swing high. Let's, in fact, just use the dashed line. So we have this swing high to this swing low. Okay, that's now our trading range here. When price pulls back here, we go down to that 15-minute and we look for that liquidity. If we don't have any, okay, we don't in fact have any here. So what we need to do, go down to a 5-minute. Let's go back to that area. Let's zoom in. You'll find liquidity is on every single time frame. So here we have this swing high. Let's mark it out. We create some equal highs here and here. The market doesn't actually break structures downside, but we do then sweep through here and then we break down and we continue down. Now, when we come back up, again, the market is sweeping through this high here created. So we're going to see those sweeps when the market comes back up. But understanding that this was our trading range here to downside, we've pulled back above this. Now, instead of we seeing the engineered liquidity at the reversal, we're finding the liquidity on the way back up here using the line chart. You can see how simple this is. Now, look, if we go back to the 4-hour, let me in fact just wipe all this off. And I'll show you that this will work on a fractal nature, understanding timeframes. So let's look for a swing move here. So we've just broken out this swing high. Let's make a dashed line. So that means we have a trading range right now from this low to this high. We're now pulling back. We go to a 4-hour time frame to current price. When we're at current price, and they can't see those lines at the moment, they've to the weekly, so let's mark this off again. These are our trading range lines. We look for the market to pull back. Now at the moment, we haven't engineered any type of liquidity on a pullback, so we can look left here. We have a swing low here, but the market's now pushed through, okay, potential sweep of this low. But if we look here, okay, we have these lows. One broke structure. You're looking for those areas where you see the continuation. So broke structure as a swing low. Here we broke structure. So that's a valid swing low. That's what you're looking for, that swing pullback. This isn't a swing pullback. This will be one candle. This is a swing pullback. So again, there's a low. Now this is a swing pullback. So I'd actually be looking at marking out this low. And you could also mark out this low. So if you're looking to the left, that's how you identify liquidity, sitting below these lows on these swing pullbacks. Now, when we're looking for liquidity out of here, what we're looking for is the market to engineer something. So we can see it's the last push down here. In fact, let me go closer into that move. Now, if we can break through this high here, then pull back, right? So we broke this high. Now it looks like we could potentially go higher. Very often you'll see a small pullback, then drop through to take that low, and then we see the real move away. That's how they're engineering that liquidity when they pull back into that zone. And you're going to find this will be your sweep area, removing that area of liquidity, and we see the reversal pull back into your area of demand, and we continue higher. That's how we look at the use of liquidity when we're using the combination of that line chart. Liquidity sweep strategy. That's what I'm going to bring to you today. Let's have a look at the chart. I've just opened up a USD daily time frame, but the strategy I want to share with you today is a very simple strategy you can start applying straight away after this video in your own trading. So what we're looking for, we're going to use a combination of supply and demand with the use of liquidity and this one simple pattern. Now this is the sweep pattern. What we're going to be looking for is we'll look for a double high to be created and then a sweep of this high to run down. Okay, so all we're going to be looking for is a run of these highs. Now what we're looking for this to happen though is below or above an area of supply and demand. That's all we're looking for. So we're looking for an area here of supply to have this formation to be created right below the supply. What this is going to do is going to bring in those sellers here in the market early, push the market away. We're then going to find a manipulation phase, push the market back higher to sweep these highs, take the liquidity, and we're also going to have breakout traders with buy stop orders as well. We're even going to have traders who are going to be looking for this move here. Let me just show you. To be broken, retested, a continuation. So we're going to have the breakout retest traders as well. But what you're going to be using the strategy with is you'll be expecting the liquidity to be run into the supply here. Okay, this area of supply for continuation down, okay, to run the next swing low. And we're going to apply it to this USD chart. We'll go through this daily time frame quickly, and then perhaps we'll look at a lower time frame of the 4 hour. So let's look at anywhere on this chart. Let's just start around here. So again, the pattern we're looking for. The first thing we need to see is a bullish or bearish trend for this to work. Right now we can see the market has been in a bearish trend. We can mark this out as a break of structure. So we have a break of structure to the downside here, where we can see the run to the downside. That's going to leave us areas here of supply. Okay, so we have an area of supply created here. Let's mark it off, the last bullish candle. Let's get it right there. Now the market fails to break this swing low. We only sweep the low. So again, this is a manipulation phase. This is where breakout traders are going to be trapped in the market. Okay, the market has swept that low. A very good indication we're going to see a bullish move. We get that bullish move away. then we make a higher low, and we can make a higher high as we push into the area of supply. All great, okay? So it's created a small area here of liquidity in the market, okay, to be run through into the supply. But is it that pattern, the pattern we're looking for? Is it this double high pattern and then a push through to continue lower? Does it look like that? Not right now, it doesn't, no. So looking at this doesn't really meet that criteria. But what we do have is the market does eventually break this structure to the downside. We then do have these equal highs formed right here. And if we do come back in, we can identify that we have the equal highs being formed. Now we have a triple high here, in fact, and we break to the downside. So now when the market comes back, we'll be looking for this area here to be run. So we can mark this across. What is this? A previous tested area of supply. Now, if you haven't been through the supply and demand zone playlist within the channel yet, I do suggest watching that. There'll be a link above now for you to go through and watch that playlist. But what we need to understand now is we have our pattern. We broke structure. We do have an area of supply because we didn't break structure here for this supply to be formed. Once we've broken this area, now we have a true area of supply we can draw. So just remember this supply wouldn't have been drawn until we saw this breaker structure. Now we can draw it. Now we understand that we have a previous tested zone. So we need to see the market run through this high. We also have this area of liquidity created as well as this liquidity at this single swing high. So understanding the engineered liquidity created here, when we fail to run back and sweep that area of liquidity, and this is created this high, it's even more liquidity being created for the market to run through. So right here in the market, we can see we run through, take that liquidity, and we run through this liquidity, which is the last final sweep, okay, which runs deeper into the supply. But there is that pattern we're looking for, okay? That was the pattern we were looking for, that area. So after this, we're looking for a continuation of a breaker structure. That happens right there. So we look to the left. Now we can look for the next engineered area of liquidity. But for an area of supply, okay, we've got an area of supply created here. Prices hasn't really come back. We do have an area of supply on the break of the internal structure. And if you're not sure about the use of swing and internal structures, then what I suggest that you do is you actually go through the playlist in the channel, which goes through market structure. It will cover all of that. And again, I will leave a playlist link above now for you to go through and check that out. So when we look at, we just change this to a dashed line. This is my internal structure, okay? This is my swing structure. We've broken through here. And as we break through, we would have left an area here of supply. So the actual zone would have been right there off this indecision candle. Let me just mark it off the actual candle. That's my last buy to sell move. Now you can see at this point, the market wicks back in and leaves this tested zone before we break out, just like we saw back here. Are you starting to see a pattern forming? But we're looking for this pattern, okay? But we do have a single test of the supply again. We've broken out. This creates this high. Okay, again, let's just go with the price. So we can see we have a push up, a drop, a push up. We don't quite create that equal high and we push down, but you're never going to find the markets always equal. And we follow structure here. Let me show you again. We have another push up, pull back, push up, pull back, and then we break through. What does that show us again? There is our engineered pattern of liquidity. There's our equal highs. This one didn't quite form as expected, but this pullback here has. And also on the way back, we can identify this area here of liquidity has been created where we're looking for price to run this daily week low. Okay, this is all understanding structures in the market with liquidity. So this is a full strategy you're applying. You need to understand supply and demand, market structure, then liquidity as well. But there is our pattern. That's the pattern we're using in this liquidity strategy, this sweep, okay, strategy. We sweep through this high, and there's our final sweep of the tested zone. There's your entry inside the area of supply. So look, if we was taking trades here, I would have took a trade off this level to be swept, stop the high to take out this low. A 6-to-1 risk to reward. Taking this trade here again, entry off the sweep area, stop above the high, target would be the week low, just over 4-to-1. So you can see how you can easily use this strategy to help you to find those trades. Let's bring this across here. And again, after we break that structure, we pull back. Okay, we've created another break here. So we have a new area of supply. So you can see this is my last area. This would be my new area of supply. Now, on the way down, we don't create our pattern. Okay, so we don't have that pattern. All we have here is a swing low, swing high. And again, we can see that is swept through into the area of supply. And where do we run straight for? We run straight for this low. So we run for our week daily low. So this in itself, again, is another sweep, okay? But it's a single sweep. It's not a double test like we see over here, okay? It's just a single sweep. But they still work very well. But this strategy is to understand that equal high was created. Now, if we'd have created here, okay, after this breakout, we'd have created a pullback like this, and then we push through. That's what we're looking for that pattern. So again, we can continue to follow this market along. We have, after this breakout, a new area of supply that we can draw. Okay, we can draw this candle. So we have a new area of supply, which is created. And again, we create this pullback before we break structure. Okay, so this high. And this time, we do create some equal highs here created, push down. We sweep this low. Okay, we do have another low, but we push up, pull back, and then we push into the area of supply. So what do we have here? We have an area of liquidity created here of equal highs. So this is created, which we know the market's going to want to push through into the supply. We create this high, which is also swept. Now we just move this, you can see we just about nearly tested that supply. We create another equal high. This time it's not quite like this, close together, but it's still an equal high. So if I just remove this line now and show you on a bigger scale, we have this test, a pullback, this test, a pullback. We then push through the equal highs, okay? And then we run this low. This low here gets run. It's another breaker structure. So you start to see how you can use this strategy, understanding this pattern. Now this pattern here, we just grab this, take this over here. Okay, this pattern doesn't have to be this close together. Like I just went through, we could have this equal high. We have a push down, a push back like this, and then we see that move. Okay, it doesn't have to be close together. It can be equal highs further apart, like we saw here. This area here, very close to equal highs. And again, we would use the same process. Above here, we look for an entry off the supply, stop with the high, targeting the low. So just over 2-to-1. Anything over 2-to-1 risk to reward is a good trade to take. That is how we simply use this sweep strategy, using this pattern format. Now, obviously, if we're looking for buys, we're looking for this. Double test the low, okay, a sweep through continuation. So we're sweeping that area of that double low, okay, sweeping the area of double high. I've shown you there looking at sales in the market. So let's have a look now at a 4-hour time frame. Let's just drop down to a 4-hour. And what we'll do, we'll go to current price for this and just swing across. And let's see if we can use this on this last move up even. Let's have a look closely and see if it would have worked. So identifying a breaker structure. We broke here to a downside. Let's mark this out as structure break. We've then broken back to the upside, which leaves us a new area of demand. So that area of demand is going to be from this low. Okay, so we have an area of demand here. So we pull straight back into that demand. We do sweep a low of liquidity. To do this is here. So we have a sweep of that low of liquidity. It's not a break, so let's just change that to a 4-hour sweep. So you can see the market sweeps and then we push through. So is there that pattern we're looking for? What we're looking for now is this pattern here, aren't we? And then we're looking for the sweep to run up. This pattern is not created. It's just a single sweep in, and then we see we continue to run through. Now that happens again. We can see another single sweep there in the market, okay, before the market pushes higher. So these single sweeps, you need to watch out for them as well. It is not the pattern we're going through today for a sweep, but that is a pattern will work. Now here I can identify to you another breaker structure right here in the market, but I can also identify this time we've created this last sell to buy move. So in reality, this is a full area of demand you could draw. But we could also just come down to this last bearish candle here before the breakout if you wish as well. And you could even look at using the wick of this candle because this is the last push up. Very often these wicks are where we're going to find those last orders left over for that area. Now, when we do break out this pattern we're looking at here, this sketch, okay, we can draw this. We can identify from this point we break out, we pull back, we run higher, but this time, okay, we create this triple effect and we drop in, we take out all that liquidity into this wick and we push out. Okay, it's not the easiest sometimes to see, but we can identify this triple area here created of liquidity in the market. And this wick is the obvious area to look for, area to trade from. You could just use this full zone here, this move up if you wish as well, an area of demand. If you're not sure about trading wicks, wicks do not always work in your favor. So you can see this is the last kind of down candle before the break up here. There is a small candle in there as well on that wick. But if you want to use this as the last down candle, this one would be the full move as well. Okay, from this swing low, we do create this higher low here internal structure. Understanding the two different types of structures, obviously you need to go through and watch that playlist. This is that pattern once again with this type of pattern. This time we're looking at the buy, okay, running into the area of demand. Now I know this is perhaps for everybody to say, this is in hindsight, it's in front of you right now. Go away, back test this, okay, test it out for yourself. Take up this high, we're looking at nearly 3-to-1 risk to reward. Okay, everything you do, everything I share on this channel is for education to help you to become a better trader. But you do need to do the work yourself. You need to go away and you need to back test everything yourself. Okay, find out if it works for you. Some things may not work well for you and your type of trading, your mindset. It's all about understanding, reading those markets. We can see the continuation here of structure. This area of demand, this area of liquidity was created, and it's a good area to observe. Yes, we did break structure once more. You could look at this as a break of structure to the downside, but also you can see it as an area of liquidity where we can see this pattern has been created. Now you could either look at just the last two or the whole three areas creating that liquidity. It's engineered for a reason, to push the market deeper into this wick on this candle. So when we're looking for liquidity, the way I use liquidity in the markets is a few different ways. But one of the main ways we can look at liquidity is when we see the market creating these moves in a trending pattern, and then you see the market drop down and then continue up. You may be looking at this thinking, well, why did the market do this? We've been in a nice trending pattern and we broke to the downside. Now, many will be looking at this as a break of structure, perhaps, okay, and a continuation back to the downside. They'll be looking at a swing point here in the market with a trend line breakout, perhaps, looking for pullback, and then they'll be looking perhaps for the market to pull back here, back to this trend line, and a continuation back down. Now, if that's how you look at trading already, perhaps it may well be how you're looking at trading. I don't know. This, in fact, is how many traders will trade. But what I see here is an area of liquidity. This is a trading range to the upside. And once we see the market gets this swing low, there's an area of liquidity here. Why? If you're taking a trade, let's just go through something. Let's say we had a big area here of demand. And you saw an entry here on a lower time frame or even off this time frame, whichever it is, and you've taken a trade up and you're holding this trade. You took some profits at this previous high. You're holding this trade. Where have you placed your stop? Well, 99 out of 100 times, most traders are going to place their stops below that swing low when they've taken their entry. Some traders may well put their stop down here, understanding that this can be manipulated and taken. Why? Because this is an area of liquidity where we're going to see the markets push down to take this liquidity, basically taking those stops, and then we can see a reversal. Now that's done deliberately to fool the market, to push the market higher. Let's go through an actual example of this. Whoops, let's do that again. Let's go through an example on the chart where we can see this. There's a few times you're going to see this happen on a chart here. First, let's look at this area here on the chart. So we can see and identify the markets made this lower high. Okay, we broke this structure here, lower low, and we pulled back and we wicked through. Okay, here this high, continued down, made a higher low, and then we pushed up again, and then we wicked through this time instead of closing through and closing back through, and then we continued down. So there is your liquidity. Let me show you why. When we see the market come back up here, we're coming back into an area here of supply. It's, there's not a bad trade. Honestly, it's a good trade. But most people will be looking for the market to do what? To most probably take this low. That would be that target out of this area. Look what happened. We made this high and we pushed up, this high low, should I say, and we pushed up to take this high. Look what happened down here. What do you see? Let's go closer in. What do we see here? We see the market from this low, pushing up, pulling back, okay, and then pushing back to the high. What happened here? Okay, so we had one. Okay, the market broke the trend line. Perhaps we're looking for a sell here now. And we went up and we took out this area. This is an area of liquidity. Anybody who's bought up here and perhaps hasn't even seen this area for a sell, they have basically now taken a trade, okay, left their stop below this low. What happened? We come back and they're stopped out. This gave the market fuel to push the market higher. Now, if you was looking for a sell here out of this area, let's say, let's remove this trend line. What else has happened? Well, the market, let's remove this again. We go through again. We can see the market pushes down, pulls back, push down, pulls back lower, and failed to continue down, and it's come back, and then we dropped off. So what we can see and identify here is the market's making the lower highs. Potentially, you may have sold out of this area, targeting this low, failed to get there. Stops were taken here. The market's pushed back up, took these highs. Stops were taken here with people who put their stop above this high or even above this high, and they've sold down here. So this has all been a liquidity area in the market. This area here, all liquidity, been taken, pushed the market down. Now, you're probably thinking, is there a way to capture this trade? Yes, there is. There's a great way to capture these types of trades. Now, in fact, I call this a banker's pattern here. And we can see the market drops to the downside. We continue down here, and we can see the same thing happens again. So what does the market do? We push down here, okay? Pull back, continue lower. We then pull back here, fail to go lower, and we continue back up. And then we've dropped back off. So let's look at this again. What's happened? Well, the market is basically swept through this high. What is above this high? What has everybody just done at this high? Well, we have grab this, an area here probably of potential supply on a drop-based drop area. Markets pulled back, took out this high here, and then we continue down. So even here, okay, area of liquidity. People sold down here, and the market's gone back deeper into this area of supply. Deeper, took out these highs and liquidity. There was the stops, pushed the market lower. So there was the area. Then we've pulled all the way back up here again into this larger area of supply. And if we take it from here even, and we've bounced out of the supply, continued down. But again, we had to take this liquidity above this high because it's where the stops hit. And then we continue lower. So you can see how the liquidity will come at these areas. Now, when you are actually using the combination of liquidity with like supply and demand, you're going to have that edge in the market. Now, supply and demand is the way I trade, and I use with supply and demand imbalances with liquidity. That is how I trade. I'm not sure how you trade. Perhaps leave a comment and let me know below this video how you actually trade, what you use, and the results you're getting. So if we continue down here, we can see many times we're going to see these areas being taken here even. Okay, we have here an area of imbalance. The market pushes through this area, this high, takes any stops anyone perhaps was sold here on a smaller time frame. Personally, I would have been selling there, but we break out. Okay, we continue down. And again, we can see this all over the chart. Stops above here, push the market, come back, take them, push the market back down again. And even right now, we do have this push through this high. Yes, there is stops here again, and we could see another push back down. But we are also within a larger range, okay, from this move to the downside. So we may want to see the market push up higher. And then we have a different type of liquidity. And we have this area of liquidity. What I see here is some equal highs left over with an area of imbalance above. Now that's something completely different, but this area of imbalance here will need to be filled at some point. And we can see these areas of liquidity left below these zones of imbalances and this area of supply, okay, where we can see them be taken. So we have liquidity above these highs, and we have some equal highs, which creates liquidity when we have like an area of imbalance or supply above, and the opposite when we're looking at demand. So at the moment, if we're looking at this, let's say the market falls back down, we're still looking for buying. Where would we be looking for that liquidity? This low. We'd be looking for the market to potentially perhaps want to come down, take this low, then push back up to take this area of liquidity. That's how you look for these trades. Let's look at this push down here. What did the market do? Okay, we had this swing high where people would have sold. We pushed through that high. Now this is when news is coming out, and many people just looking at price, not understanding why. This is a high of liquidity. The market's pushed up, but before that, before it could push up, see this low here? See that one little low into this area of imbalance? Had to push through that low where we had buyers. Took out the stops, boom, pushed the market up. That's all the market does. They take liquidity on all sides. This low here in the market, left over, higher low, that's an area of liquidity. At some point, that will want to be taken. Now, let me just show you again here. Do you see a pattern? Let me show you again. Some little equal lows. Do you see a pattern? Let me show you one more time. You see those higher lows on the pullback. There's a pullback, pullback, pullback. That's a pullback. Even this bit is. So where's price going to want to go? That takes out the area of liquidity. Nice drop down. Area of liquidity. Nice drop down. Area of liquidity. Nice drop down. Area of liquidity. So what we're looking for a powerful drop down again, the continuation to take out the area of liquidity. So there you've seen a few different ways now I look at liquidity. We look at the swing highs to be taken as liquidity. We're looking at these areas where we have equal lows. They're not equal in when I say like equal exactly the same price. No, they don't have to be. Okay. They are areas of liquidity left over the lows where the market's taken it. We can look back and you'll see this over and over. Look here, they are equal lows this time. Just here in the market. Area of liquidity. Market takes it out. Again here. This is the pattern I'm trying to show you. Liquidity. Market takes it out. So you've seen those two areas now, how I look at liquidity. And that's the way I would look and use liquidity to help with your trading, only to combine it with supply and demand. Okay. That's how I trade, and that's how you combine it with supply and demand and everything else. Once you understand what liquidity is, where it sits, it's going to help you when you're taking trades. If you're selling up here, you know you're going to take out this liquidity. That's your target. Even if you sold on this candlestick, that's my target. That's how I'm using it. Now, let's say you took a buy here. Where would you be targeting? Well, you can be targeting the high because that's the high of liquidity. That's where you expect the market to want to go. And if you were selling here, let's say, where would you sell? Well, you'd either be selling at this low I've just marked or this low, because they're areas where liquidity would sit. In fact, not liquidity. Let's have a sweep. It's not really a sweep push through. That would have been an area of liquidity. This is an area of liquidity. This is a main area. So yeah, you may well have thought we could have sold here to this low. But at that point, this was news, not a point where I would be trading. And in fact, you can see the reversal. So you may have been stuck in here, but even if I'd have sold here, I would have got out here because that's my first area of liquidity in the market, this swing low, not this one. So if I'm selling here, that is my target because there's nothing there to stop me. Okay, if I'm selling, well, on this move, if we found a move up here to sell, there's my first area of liquidity. These equal lows. This is the swing low, okay, of liquidity. So I hope this has helped you to understand the way I look at liquidity in the markets, and perhaps you may be able to use that in your own trading. And if you want to check out that profit trade workshop, there will be a link popping up at the end of this video.